Hello, everyone, and welcome to TradeFinder Live. My name is Zach. I'm one of the team here at Elliott Wave Options, and I'll be facilitating this session tonight with Rob Roy. As always, we need to go over some important housekeeping details about the session, and then I'll introduce Rob. First and foremost is our live disclosure disclaimer agreement. If you've attended any of our live sessions previously, then you've seen this. The main thing to take away from it is that we are not licensed investment advisors in the United States, so nothing is to be taken as personal investment advice. We do have this available on our website if you'd like to read it in full detail there. Certainly feel free to take a screenshot of it if you like, but that's the main point to take away. Alrighty, so without further ado, we have lots of exciting topics to cover tonight, so let's go ahead and get into it. And I'm going to go ahead and pass over to the man of the hour, who we're all here for, and that's Rob Roy. How are you tonight, Rob?
Good, Zach. How you doing?
Doing well, doing well. Excited to be here.
I'll turn my video on if you'll let me.
I suppose maybe this time.
I'm not sure it's a good thing, so perhaps we don't do
it. That's odd. It was on before. All right, try now.
Did that help? Did we come on?
Try one more time. There we are. Oh, there's your screen. There we go.
Okay. There we go. Thanks. Everybody, welcome to this week's TradeFinder Live. And pretty much everybody's waiting on the economic news that'll come out this week. But moving prior to that, you can see that we have had a little bit of a tick up yesterday and today. So looking at the Elliott Wave pattern, you can see we are still in a corrective mode, which means we want to further take a look at that zigzag pattern that we've been looking at for quite some time now and see if we are going to head above this 410 level. That's the key, in my opinion, is whether or not we can get in front of this 410 level. Just real quick while we're talking, you can see the background's different. I'm not in the Dragon Capsule nor up in the mountains, visiting with some family. And that's what happens when you live in Florida, is the fact that all of your family wants to come see you and figures that, you know, you can be a great host because you live in paradise. So in a hotel in the Orlando area. So that's why the odd background is something that you haven't seen before, but we're here and ready to talk the markets. And so with the zigzag pattern, again, we are bumping against that 410 level. That's the importance, I think, is that we need to get above this 410 level. And you can see we are above the 10-day moving average. So there's 410 that coincides exactly with the 61.8% level. So there's a double whammy, if you will, there on the resistance area. So can we break above this? Can we get above this 410 level so that we can move up towards 434? And you have to look at it as, well, as long as we stay above the 10-day moving average, the 10-day moving average is moving to the upside. In the last market update, talking about the potential to move higher. Wow, some of you are pretty committed to the fact that the market's going to move lower, and some choice words for talking the markets higher. But all I do is just read the charts and the best that I can from what I see. I don't have a particular viewpoint one way or the other of which way the markets are going to go, because I know the markets are going to do what the markets are going to do. So you can choose to trade the markets the way you think they're going to move, or you can choose to trade the markets the way they actually move and listen to the market. And I can tell you from trying both of those that listening to the market and trading according to what the market's doing, regardless of whether that's in line with what you think it should be doing or not, is a far more successful way of trading. But I would like to show that we are creating a pretty large ascending triangle here. Now, that doesn't mean we're going to break to the upside, as you've heard me say numerous times for those of you that have watched this. And again, thanks for all of you viewing from the various social media platforms. An ascending triangle does not mean we're going to break to the upside any more than a descending triangle means we're going to break to the downside. all of the triangles, descending, symmetrical, or ascending, just mean that we are forming some consolidation and a breakout is likely. That's what a triangle means. And there's no secret to the fact that 410 is pretty significant resistance, but moving up to that from the lows in October, we have a series of higher lows. Now we could break either direction from this triangle, and whichever way we break, that's the way we'll focus on trading. For that zigzag pattern to complete, we've got to get above this 410 level with some follow through. Now, does it take the breaking out from this triangle to do that? Perhaps. We'll see how that plays out over the next couple of weeks. But for now, you look at this from the bullish side of things, whether that makes any sense to you or not. And listening to the financial networks, people are all over the place on where they think things are going to go at this point in time. Some people think that the Federal Reserve's balance sheet is contracting, others think it's expanding. It's really amazing, the diversity of where opinions are. And when I get some of the comments that I got out of the last video, that's what really makes a market. Now, I always welcome people that have an opposing view and it's not my personal view, it's the way I read the charts, but I welcome opposing views because that's what makes markets. For every buyer, there has to be a seller. Everybody can't look at the markets the same way. So that's, again, disagreements are what makes the markets. Let's look at the indicators, find an indicator you trust, get good at learning that indicator, and then trade accordingly. And that's what we've done at EWOTrader.com with Elliott Wave. We have our confirming indicators to back it up. But for now, above the 10-day moving average, at major resistance at 410, let's take a look at the VIX. I think it's important to look at the VIX because it's down, no doubt about that. If you are bearish on the market, which I've learned a lot of you are from your comments on the suggestion that the market could go higher, that was not a popular viewpoint, but that's the way the markets look to me at this time. You can see the VIX is down around 19. So if you're bearish, you've got something pretty good to hang your hat on here. We're at an area that has formed a bottom on the VIX for quite some time now. Could it go lower? Yeah, we've been down at 15, we've been down at 12, and we even broke 10 at one point in time in the past. So just because we have a lot of support here in the 18, 19 range doesn't mean that has to be the ultimate bottom and that we have to bounce to the upside on the VIX. We could break below this, but every time we come down here, we seem to break a little bit higher. But note that we've been down here. We're starting to build that, for those of you that are longtime viewers, launch pad type of effect where we're going sideways here, and then we have the potential for a blast off move on either direction, not necessarily just to the upside, but you usually get a significant move. So, I don't think we're going to have to wait too much longer. That's about 2 weeks worth of trading days that have been down here around 19. So I think we're gonna figure out which way we're gonna break from that triangle in the not too distant future. Looking at interest rates with the TNX, I think this is very constructive. The fact that we bounced a bit right when it looked like we were breaking below 34 and perhaps ready to go down to much lower levels on the TNX, we turned and came right back to the upside. You've heard me, if you've watched any of these videos over the last several months, say that I feel like the sweet spot for interest rates is to stay in a trading range here between 34 and 40, just bounce around in that area. We are in a qualified 5-wave to the downside pattern, but we're in a wave 3. And if we bounce back up to the wave 4, that's dead smack in the middle of the trading range that I think is healthy for the markets. And the reason I say that, for those of you that are like, why wouldn't you think that rates dropping is a benefit to the markets, is because if we get a significant move down in rates, that means prices are moving up. And for prices to move up that significantly, money likely is coming out of the equities market to make those prices move to the upside. And that's not conducive to equity prices going higher. So just kind of this trading range in this area, that's the sweet spot, in my opinion. So bouncing back above 34 on the TNX, I think is extremely constructive. And then we look at the dollar, and you can see that a 5-wave to the downside pattern is qualified at the moment. We're trying to break below this level here, right around 102. Same type of thing that happened with the TNX. We broke below it and turned around and came right back above it. I wouldn't even be too upset if the dollar made it all the way down to this wave 5 low, just as long as it stays above 96. And I won't go all the way back in time to show you why I think 96 is important, but 96 is in the middle of that tap box time and price projection, which is a really great benefit of the Elliott Wave algorithm included in this software, which, by the way, if you're not used to it or it's new to you, is called Profit Source. You can find out more about it at hubb.com. I think it's the best Elliott Wave software that exists in the market. I've tried every one that I know to exist. I'm not going to say that I've tried all of them because perhaps there's some out there that I'm not aware of, but of all the ones that I am aware of, this one has been by far more accurate. And part of that, I believe, is because it's programmed exactly to Ralph Nelson Elliott's algorithm. It's not a personal adaptation of the algorithm, which a lot of people seem to do. And what really amuses me at times is if you've ever taken a look at the algorithm, it's a number of pages of code. And the people that look at a chart and think that they can manually label Elliott Wave, I just think is ridiculous. There's no way that just looking at it and thinking, okay, that's a 1, 2, 3, 4, or 5, or an ABC or whatever. And when you see the amount of pages of coding that went into the actual mathematical algorithm, there's so many more things to consider than just looking at bars going up or down or candles going up or down, and impulses and corrections. There's a lot more to it than that. If it was that easy, everybody would do it. And it's not that easy. Nothing in the world of trading is that easy. So anyway, I'll get off my soapbox and we'll move back to looking at some of the rest of the markets. Let's take a look at the diamonds. So we'll look at the DIA. And you can see that moving back to the upside, really nice move here from 320 on the DIA. Just when we thought maybe the Dow was going to just kind of fade away and let the NASDAQ, the Qs, and even the SPY be the leader, and that the Dow had really relinquished its role, he tried to say, it comes back and reasserts itself. And now we'll find out because we have a bit of resistance there at 340. Can we break below, or excuse me, break above that? We'll see. Perhaps we can. And if we do, then maybe that's the green light for the rest of the markets moving forward. As you know, we're in that big ascending triangle in the SPY. Now let's take a look at the Qs, and you can see the pattern that exists there in the Qs. So we have really different setups in the markets. We've had that in the past. And as I've said in the past, when things get kind of discombobulated this way, it doesn't last long. Normally the markets will come back in sync with each other and be congruent. And I think that will happen again. But so for right now, we have the DIA moving up towards resistance, kind of in a trading range. We've got the SPY in ascending triangle. And here we have the Qs in a 5-wave pattern to the upside. We almost made it into that tap box, which stands for time and price projection. But the key here on the Qs, if you're long the Qs or you want tech stocks to go higher on the Qs, you want to see that stay above 310. As long as that stays above 310, regardless of what else is going on, you stay long the Qs. It breaks below 310, then you have to reevaluate and change things. But unless that occurs, you stay long the Qs. So we're above the 10-day moving average. We have held that area at 310, which was also right at the wave 3 high. Pretty constructive looking chart there on the Qs. Now, here's something that you might find interesting. The IWM, which had been kind of lagging. We talked about the fact that it's not participating in the upward movement of the SPY and the Qs specifically. Well, it's trying now. It's trying to get its act together. It's above the 10-day moving average. We're trying to move up towards that 50-day moving average. And you have to appreciate the fact that there's a tiny bit of risk on here. We've mentioned that numerous times, that you look at the IWM, the small caps, as a good indication of risk on, risk off, because that's viewed as the higher risk market of all the different markets. So if the small caps are starting to kind of tick to the upside, you would think that yeah, maybe we're starting to feel a little bit better about the risk on environment. And when people come out with, all the different scenarios with the fact that we're likely moving into a recession, I do believe that the GDP is going to show a recession in the second quarter. But that's being priced in. It's so important to remember that the market looks 6 to 9 months ahead. So if we get the GDP data that comes in the second quarter and shows that we're in a recession, so we have 2 consecutive quarters of negative readings for an official recession. We've already had one from last year, which nobody seems to focus on anymore. It doesn't mean anything other than that's the indicator of a recession. But the market has looked past that already. And I believe, this is my personal opinion, that the market is looking past perhaps this less rate hike. As we commented last week, Canada has already, their central bank has paused. Australia's central bank has paused on raising rates. We have 25 basis points baked into the April meeting of the Federal Reserve. Perhaps they do the 25 basis points, or maybe they surprise the markets and say, we're going to pause right here and look at some more data before we decide what to do, allow some of those other rate hikes to work their way through the economy before we move forward. But even if they do raise another 25 basis points and then say, all right, we're doing this and now we're going to pause, that's what the market's looking towards. The market is already moving ahead towards when is the next rate cut going to be. It's not focused on, are they going to raise rates at the next meeting? How long are they going to pause? The market is looking towards when are they going to cut rates. And that's evidenced, in my opinion, by the fact that the Qs are doing well, because when the rate cuts start, that's kind of when it's the old buy the rumor, sell the news. Once the Federal Reserve actually starts cutting rates, I think the upward moves are probably going to be done at that point in time. And right when everybody thinks that, okay, the Fed's cutting rates, let's go along the Qs are going to be like, hey, you missed out. We've been doing this. We've been talking about this for a while. And maybe they reverse at that point in time. It'll be interesting to see how it plays out. However, all that aside, I got off track here a little bit. I don't ever do that, do I? Go off on tangents. I'm sure Zach is laughing in the background, but the bottom line here is that the IWM is starting to join the rest of the markets, and in doing so is showing that there is a little more risk tolerance in the markets. And speaking of risk tolerance, let's take a look at the cryptos and Bitcoin. How about this move? Did you see that? So long we stayed, and people have asked, and this has come up on YouTube so many times, not so much lightly as it did in the past, but does Elliott Wave work on cryptos or Bitcoin? And when you look at this pattern, you had a 61.8% wave 4 correction, 100% wave 5 extension that consolidated. Look at that. Dead smack in the middle of the tap box, exactly where it's supposed to be. Let me take these moving averages off here and look what the consolidation was. A triangle. What's supposed to happen out of a triangle? A breakout. Remember how many times, those of you that have been watching a lot, how many times have I mentioned that Elliott said, don't diss the small triangles. Everybody gets so focused on the large triangles, like the big one that we have on the SPY right now. Don't forget about the little ones. They work too. And that's exactly what happened with Bitcoin. We had this symmetrical triangle dead in the middle of the consolidation that occurred in the tap box. And then bam, bam, there's your big breakout on Bitcoin. Now, the key is, all right, that's kind of where the breakout was expected. What happens now? I don't know. We're going to have to wait and see and let the charts tell us what's going to happen. We had this triangle. You look at those 2 days there. That's about the forecasted move on the width of the triangle. So putting the 10-day moving average, you can see we're a little bit overbought now. There's where the market is and the 10-day moving average. So we're a little bit overbought at this point in time. I think that you pause and you wait and see where Bitcoin can go from here. We all know that we're moving into that area, and you make fun of me every time I try to say this word, halving, I don't know what the word, how it's pronounced, but what occurs with Bitcoin periodically is supposed to happen in the first quarter next year, and historically about a year before that, which is where we are right now. is when the cryptos tend to rally. Is that what's going on now? Very likely. That's what's occurring. But you couldn't script a better Elliott Wave Fibonacci pattern than what's occurred with Bitcoin. With the 100% extension, the consolidation exactly at the target, multiple weeks going back and forth here within the top box, the consolidation into a symmetrical triangle, and then the breakout. It's just as classic as it gets. So if you are a crypto trader and if you do like Bitcoin, you could do a hell of a lot worse than looking at Elliott Wave as your indicator on where you think Bitcoin in the crypto world is going to go. And it's been pretty spot on for quite a while now. It's not just this last pattern that's been working out. So let's take a look at the EWA for our friends down under in Australia. As you know, on Thursday nights in the insiders meeting, we do look at the EWA and the XJO because we have some subscribers that prefer the XJO. We have a lot of subscribers that prefer the EWA. So we look at them both on Thursday nights when we have more time. So for here, we can see that it's moving to the upside. We held 22, which was the key, right around the 61.8% level. So I think at this point, you stay long the Aussie market if you're watching this, and you've got a little buffer room here, in my opinion. And what I mean by that is it was key, I think, that we got above 23. We broke above it. We came down and tested it. We moved higher. And if you want to let that be your area for a stop, if you want to be long the Aussie market, you can let 23 be your stop on the EWA, or you could be a little more flexible and allow 22 to be your stop. A break below 22, however, you should not be long the EWA, in my opinion. But above 23, and even a case can be made of above 22, because that's where the wave 4 is labeled, I think makes an awful lot of sense. So that's pretty interesting, especially when the fact that their central bank is on pause. Look at this move in the EWC, the Canadian market here. 32 holding, which was really important for it to hold. And then the next level was 34, which we've gotten above. So we're above 34, not that overbought, a tiny bit maybe from the 10-day moving average. It certainly looks like the EWC wants to go up here and test these highs at 36 from January and February. Then we'll have to reevaluate what occurs on the EWC. But I think you have a bullish trade there, if you'd like, on the EWC up to 36. And then, as I said, you have to reevaluate then, because that's where it's going to bump its head on some resistance. Where do we go from there? So let's look at India, the INDA, which has been doing better, getting back above that 39 level, which that was the important level. It needed to get back above 39. It did. Now look what's happening is it's trying to get above 40, and it did break above 40 today. One day doesn't mean anything. Remember, you have to have a second day of follow through, a confirmation day when you break a major point of support and resistance, a major moving average, break out of a triangle, etc. Any of those things, one day is meaningless. You have to have that second day, the follow through or confirmation day. So the next day that occurs on the INDA is going to be key. But then you have to look at that. Even if we have follow through tomorrow, we're so close to that wave 4, meaning that the wave 5 ends, we retrace back to the previous 4. And that's where in the world of Elliott Wave, you say, all right, that's everything that's supposed to happen. A wave 5 finishes. If it hasn't been more than 100% extension, it goes back to the previous 4. Those things occur. And then you wait and see where the next impulse comes and labels. And you just basically, to be honest, you sit on your hands for a while and wait and let it tell you. And I think that's been the theme of tonight, is listen to the market. Trade according to what the market is telling you, not what you think the market should be doing. And boy, it sure sounded like from all the comments over the weekend that a lot of you are trading on what you think the market should be doing. And the market's been kind of maybe not going in that direction, and you're angry and upset. Well, don't be mad at me. All I'm doing is just giving you the best information that I can from a lot of years of experience, a lot of technical analysis, and a lot of years with Elliott Wave, and just reading the charts the best I can. It's not my personal opinion. I'm just reading the charts. And so I'm just going to try to share with you what I see out of them. It's nothing personal. So looking at the EWG here, man, just flexing. So impressive, I think, what's occurred here. We broke below 28, that area of resistance, and it looked like, okay, down here in March, we're about to head down to this previous 4. Not so fast. We held the area at 26, and what was key there? That's where the previous wave 3 high was going back to December. Held that area, turned around, jumped back up, good positive 1030 cross here, and now we're back up at these highs around the wave 5 that occurred back in February. So if the EWG can get above 29, I think you have something really special going on there. I think you could have a really nice move, but it has to do that first. I think that you'd be really aggressive to jump in now. You could if you wanted to, because 28 could be your stop. But I think if you want to be a little more conservative, and I try to give both views, oftentimes, if you're more of an aggressive trader, maybe you take action, now or whatever. But if you're more conservative, let this happen and then you jump in. And so if you're really aggressive, you could trade now thinking that, okay, it looks like we are going to break above 29. But if you're of the more conservative type, let it break above 29 on the EWG. But it certainly is one of the better looking international markets. I don't think there is any mistake about that. All right, so I did want to share with you what we looked at last week. We looked at Adobe and Google, and we did send out Google as an alert for our alert subscribers, and that's at EWOTrader.com. As you know, when we look at these trade finders every Tuesday night, we look for case study considerations, and we give you ideas. And from there, you're on your own. Manage it on your own. At EWOTrader.com, though, what we do is we send out alerts for our alert subscribers on entries, any adjustments, and exits. And so basically we take you by the hand and walk you through the entire alert. That's the difference between the two. But we did follow through with looking at Google last week. We sent out an entry alert. As you can see, here was the pattern. You know it because we looked at it live on TradeFinder. There was our target price, but what ended up happening, and this was really interesting because when I sent out the exit alert to our subscribers, notice this is 0 days in the trade. How can you have a trade with 0 days? What that means is that the entry and the exit were less than 24 hours apart. So when we exited the trade was earlier in the trading day than when we entered the trade the previous day. So it doesn't show you as being a one-day trade because it was less than 24 hours. So, and as you know, there's no such thing as a 0 day trade. It's not even a day trade. Basically, that's why it plays out. So we were able to generate 35% in less than 24 hours. And here was the return. There was the move higher. And I sent out a note to our alert subscribers. I know we haven't quite hit the target yet, but you can see this big move that we're getting out of Google today. That means that there is IV priced into the calls. And so we don't want to lose out on that. And if we can get 30%, kind of one of my general rules, if you can get 30% in 3 days or less, I'm most of the time taking that. That's almost a given rule. So 30% gain in 3 days or less, regardless of what the target is, etc. I'm likely taking that, and really, especially when it's in 1 day. And in this case, Google released some news on AI, some of their AI stuff, which apparently was very favorably received. We bounced to the upside. We got away from the 10-day moving average, so we were overbought, even though we didn't quite hit that target at the 61.8% level. Not going to turn away from 35% in less than 24 hours. We're going to take that, and we will likely take that every time, as I said. So now let's take a look just to see, because, it's fun to Monday morning quarterback. It's really fun when you're right. It's not so much fun when you're wrong. But look what's happened since then. Even though we didn't quite hit the 110 target, boom, boom, back down we've gone. So at this point in time, our exit was spot on. And so a really nice gain in a very short period of time. And as you know, we highlighted that. So anyway, that was our alert on Google. That's how our alert service works at EWOTrader.com. If you're looking for somebody to help guide you with some of your alerts, then maybe you want to consider becoming a subscriber at EWOTrader.com. Just something for you to think about. So let's go over and start looking at some of our previous case study considerations that we found on trade finders in the past. And so here's FFIV, which was a triangle. So this was a strangle. And, we kind of talked about this last week that, maybe this was too vertical. It's not the most classic descending triangle because of the vertical nature of the lower highs. And in what's happened so far, what we've done is formed just a mess. Really, it's hard to even say that this is a larger triangle. The support has held around 140 every time it tried to break that. It's held, but you can see by this latest move here, it doesn't even look like we've formed a more significant triangle, which is what normally occurs. This is an extremely rare occurrence, in my opinion, that you have a triangle that doesn't break out properly. Most of the time they do. Nothing is 100% in the market. No indicators 100%. Some of you are talking about that on indicators that are never wrong on YouTube. And I got news for you. There's no such thing as an indicator that's never wrong, or every person on the planet would be looking at it. Nothing works that way. You find a system that you gain confidence in, get good at it, and trade accordingly there, realizing you will be wrong sometimes. I know I'm wrong sometimes. That was the hardest thing for me to learn as a trader, because the more I learned about the markets, the smarter I thought I was, and the more I felt I knew where the markets should go. And then when the markets didn't go that way, it was really perplexing. So some hard lessons in the fact that you better listen to what the market's telling you rather than trying to trade by what you think it's going to do. And in this case, this is just a triangle that I think's blown up. I think we just need to forget this one and move on. It doesn't happen very often. The vast majority of the time, good solid triangles, and perhaps this one wasn't, as I surmised last week or so, by the vertical nature of the lower highs, it just hasn't worked out. So, that happens. Let's forget it and move on. Looking at Amazon, where we had this triangle here, it wasn't the greatest setup on the lower trend line with the higher lows, but pretty good on the higher lows. And from there, pretty nice little breakout underway, but it does need to hold here at 100. So this is, I think, in danger land. It's been a nice breakout. It's worked pretty well, but that 100 level needs to hold. If it can hold 100 and continue higher, then it's great. It's a really nice breakout because these 45-degree angles tend to hold when you have a move like that, rather than this real vertical stuff. And here's a perfect example. See what happened with this vertical move? It came right back down. How many times have you heard me say that? I don't like vertical moves because when something goes vertically up, it often comes vertically back down. Don't like that at all. Love this 45-degree angle, but do want to see Amazon hold there at 100. If it can do that, then great. NVDA talked about on the financial networks today incessantly. And gosh, we've had two really good alerts for our alert subscribers recently on NVIDIA. And I'm a little disappointed that we didn't come back down. I thought we might come back down and test 240. We haven't yet. So got to look at that and say, man, it may not give us that, because look, the 10-day moving average is caught up. When you get overbought, when you get the separation from the 10-day moving average, one of two things happens. Either the stock comes back down towards the 10-day moving average, or up if it's a downward move, or it goes sideways and allows the 10-day moving average to catch up. And in this case, that's what happened. NVIDIA has gone sideways and allowing the 10-day moving average to catch up. And, maybe it's ready to make that run to 300. And, I might have been being a little picky here, thinking that, hey, let's wait for that test back down to 240, because that was resistance for quite a while. I broke above it. Normally, when you break a significant point of resistance, you come down and test it and become support. It hasn't happened yet in NVIDIA. It just continues to power higher. And so how much longer do you want to wait? My opinion here, I think that you could seriously take a look at going long NVIDIA again, because it doesn't look like it may test 240. But I wouldn't be as aggressive as I would. Like I said, we've had two good bullish long alerts that have come out on NVIDIA. One was straight calls. One was in the money debit spread. So that's not quite as it is the truth, though. It's not quite as risky as buying a straight call, because you can actually have the stock move sideways or slightly against you and still make money. but it is a bullish position in general. So I would look towards something like that right now. Maybe it was a little bit too quick to go to the in the money spread, because we had this nice big breakout move here, and had we had just straight calls again, we would have had another really nice return, but we already had one, so you don't want to give that back. So you go a little more conservative, you still generate a nice gain, but it looks like perhaps if you wanted to step in on NVIDIA, you could to the long side, but I would exercise caution here and perhaps use something like an in the money debit spread, maybe not quite as risky as a normal position that you would do in general terms. All right, so I already showed you the Google position, but we also had Adobe on last week. So let's walk this back to where we were last week. And that's where we were looking, and pretty nice looking setup here, 380 being the key level. Right here, we wanted to hold 380, and we did not send this out as an alert to our alert subscribers, even though we did look at it last week and we wrote it down as a case study consideration. We did not send that out, and that was because I didn't really like what happened the next day, and the fact that now we've broken 380. If you're more aggressive, if you have a more aggressive mindset, then you can hang in with Adobe and say, as long as we stay above 360, I'm okay. I'll stay long Adobe. If you're a bit more conservative and looking at the fact that we've broken below the 10-day moving average, even though we're above the 50-day, which happens to exactly coincide with that 360 level, you could say, maybe we want to just back off. If we hold 360 and bounce, can always get back in. But if you're the more aggressive type, you just stay long where you are right now, see what happens at 360, regardless of whether you're aggressive or more conservative. If Adobe were to break 360, I think you're out. I think that's the stop and you get out of it. So, just our record on these case study considerations, if you go back and look at the recordings going back to the beginning of TradeFinder, has been pretty darn phenomenal, I think. Well, let's see if we can do something along those lines tonight and find something that works as well as Google did. When we come over here, and by the way, in the software program, you can see these searches here. These are called pre-computed searches, which means they're instantaneous. So you don't have to wait and run it. But the beautiful thing about the software is if you have your set of favorite indicators, you can create a search system. You can create a technical trading system, combining all of your favorite indicators and run back tests. And that's what I did in creating my technical trading system. And then these searches over here that had EWO on them, those are mine. Those are my searches that I ran numerous case study things. But what I would do is I would set it all up, and I would set it up with an amount invested, profit targets, loss targets, and all that, and run it for a period of time, at least a year, let it run all night, wake up the next morning, look at it. If it's no good, tweak it and do it again the next night. And I did that over and over and over again until I came up with a technical trading system that I like today. And those are included here in the software program if you're an EWO trader, alert subscriber, and you have profit source, you get those. So you can see my searches. You can basically see what I'm looking at every day. So let's see what I'm going to look at on Tuesday nights. I don't look ahead. I don't preface anything. I don't see what's potentially coming forward. I look at it live with you guys. I see public storage, which I want to take a look. Domino's Pizza kind of makes sense. I think in this area, if you think perhaps we're going to go into a recession, people still have to eat, but are they going to go out and fine dine as much? Or maybe we order more pizzas. So I think that makes sense. So let's look at Domino's real quick. And we had this gap down. We're moving back to the upside. I don't know that DMI looks like exactly where we want it to be yet. And it's trying, but the ADX is not above 20. So that is no good. So we'll pass on that one. If you're wondering, well, why do you have a search that shows up if it's not actually triggered? because I have a long list of watch list candidates that if they haven't actually triggered yet, it's on my watch list. And then I look and see day after day, do they trigger? Do they actually move and trigger? And if they do, then I put them on. But if you only set it up to where it's above all of your entry points, then you get a lot of results that are too late. You've already missed the big move. I'd rather look a little early and keep them on a watch list so that when they trigger, I can try to get in and catch the biggest part of the momentum. Take Two Interactive, which, if we are going to go into a recession, maybe everybody's going to stay home and watch Netflix and play video games. Maybe that, because Netflix has been catching a bid here lately after a little bit of a retracement. So here's Take Two Interactive moving to the upside here. We're right around this wave 5. The issue that I see here is, gosh, there's a lot of resistance right there at 125. So we close at 120.39 today. Then we've been going between 120, 121. I think I would pause on Take Two and let it break above 125. If it does, even though the DMI is not bad, you've got pretty decent separation. You got the positive directional indicator moving up, the negative moving down. You got the ADX moving up, telling you there's some strength to this move. And it's nearing 20. It's not quite there. So I think that you wait. And if you can see Take Two get above 125, that likely gets that ADX above 20. And then you might have another one that's off to the races there. So there's a couple really good ones to keep on a watch list, but not something that you may want to enter at this point in time. Public storage, pretty nice breakout here to the upside. Look at that. Let's see. Is that DMI giving us a signal here? It looks like it might be. Yep. So you can see that ADX, that's what you want to see. Positive directional indicator firmly moving to the upside, negative moving down. The ADX between the two, moving to the upside, above 20. Everything that you would want out of the DMI. We look at the Elliott Wave pattern here. It's not in a 5-wave pattern. But we have broken above. This is going to be what we're going to look at today. This is going to be our official case study consideration for tonight. Is public storage, PSA, looking like it wants to continue its upward move. The only negative here that I see is we are a little bit overbought. So we're above 310. We may come back down and test that 310 level. If we break down below 310, I would say, okay, wait, pause. Take it off. Let's see if it can turn around and get back above it. But as long as it holds 310, even if it moves back lower from here, I still think you're okay to be long this one. So that's going to be our official case study consideration for tonight's TradeFinder. And with that, Zach, I nailed it dead on. Look at that, 45 minutes in. Let's open it up to some Q&A here to finish tonight up.
Awesome. Sounds like a plan. And thank you for the wonderful presentation per usual. And would you say it's fair to say the PSA for tonight is PSA? Sorry, I couldn't resist. We'll start out with silver and gold. And
okay. Yeah, I was looking at silver today and a little angry here too, is that maybe kind of, because we had a good trade on very short-term trade on SLV, and then this consolidation here, I just really thought we might come back down and test 22, and we haven't. Look how long it was an area of resistance here, and it broke above it, and we had a nice move there. And so I thought, okay, let's let it come back down and test 22, and that'll be another golden entry. And it looked like it was kind of trying to pull back, but it hasn't come down and tested 22. May have missed this move, but that's the way it goes. You don't get them all right, but a little bit overbought still from the 10-day moving average. So still holding out hope that perhaps they get a bit more of a dip down with another ideal entry, but I'm not going to chase it when we're overbought from the 10-day moving average. But if I get another consolidation chance, I think it would probably go long there. And then GLD just coming back down, testing 185. I think that looks really interesting right above this previous wave 3 high. We had gotten overbought there, but see how this tested back down. That's what I thought silver would do, but it hasn't. But gold has. And I think that with today's bounce back from that 185 level, I think you can look at going long gold. As long as the dollar doesn't get too strong, I think the metals will do really well. And remember, the dollar isn't a qualified 5-wave to the downside pattern, even though it's holding in there around that consolidation level. But if we can just kind of drift lower with the dollar without any sort of, you don't want the dollar to collapse, because again, that tells you that the world is not viewing the dollar as the last point, the last currency or the strongest currency, however you want to view it. But a slightly weakening dollar is great for the metals. I just don't want to see the dollar really tank. But when you're looking at these metals, I think this is a really interesting, I think it's, and I haven't said this for quite some time, that GLD looks like a better entry right now than SLV does to me.
All righty. Thanks, Rob. There was a lot of requests around that, so I'm sure there's some happy viewers out there. I see we do have a hand up from our Zoom subscriber, George. We unfortunately don't have time for voice questions in this session, but we would love to hear your voice and interact with you on the insiders meeting, where we have a 45-minute Q&A portion, and you can ask a voice question there. So next up, we're going to go over to oil.
So USO, and I think that's another really good question. Look, it's just been amazing, really. We get this big, massive move up, and if you missed that news, I do believe we talked about this last week, but if you missed the news, it was because OPEC was angry at us. We said we were going to pump a ton of oil back to replace our strategic petroleum reserves, the SPR they call it, and we didn't do that, and it made them mad. So they cut production. And that's what created this big gap up in price. And as we talk about this a lot, when you get these big gap ups, one of two things happen. You get significant movement from the 10-day moving average. So either we come back down towards the 10-day moving average, or we go sideways and consolidate and allow the 10-day moving average to catch up. But one of those two scenarios occurs. So far, the consolidation move has occurred here, and we're holding above 70. And my personal belief is that anything above 70 on USO, you're long. If it breaks back below 70, we reevaluate, and that move back down there towards 60 was like, wow, is that forecasting a major recession, not just this slight recession that a lot of people are calling for? But that doesn't matter anymore because we're above 70. So my viewpoint stays the same. If we're above 70 on oil, I think you're long oil, especially the USO. And we'll see that 10-day moving average is rapidly catching up. All this consolidation dead on that 70 level seems to be forming kind of that launch pad effect for maybe a potential blast off. But that's my feeling. If oil USO is above 70, you're long. If it breaks back below it, I don't know if you go short, but we keep an eye on it. But I think you're on pause from a long standpoint. I just don't know that it means you go short.
Very well. Thanks, Rob. So we'll go over to a question from Rin. Wants to look at ACLX, I think it's Arcelix, and immunotherapy-focused clinical trial stage biotech company.
Okay. The biotechs have been challenging for me recently. So already in a space where I'm not super comfortable over the last few weeks, but looking at this chart, this has a little bit of a step down. Basically, you had a sideways move, and then we broke lower, and then we went into another sideways move. And that's what I mean by a step down. It looks like stair steps. So you have to wonder, what's the next move? Do we move down again? Do we stair step down again? Or does this wave 4 hold right at a 50% corrective mode, which could easily hold right there at the 50% correction? Holy smokes. I'm sorry. I'm sorry. I'm in a hotel in Orlando and literally 5 feet away from a raccoon that just walked right to the window and stared at me. You never know what you're going to see in Florida. Wow, that's amazing. But anyway, back to this stock. So moving sideways right through here, the potential for it to bounce from this point and move higher. I think that if you were looking for direction, you would go long because you have that wave 4 right at 50%. And if it stays there, you could get a pretty significant bounce up to that wave 5, but it's easy from a risk to reward standpoint. I think if you break below this 28 level, which is right there where all this consolidation is, that's your stop. So you could take a shot long at this, but if it broke below 28, you're probably doing another one of those stair steps lower, and I would exit that one immediately. So with the 5-wave pattern in place, you could take a shot long, but 28 breaking below that's your stop.
Awesome. Thanks, Rob. Sounds like even the raccoon was looking for some trading insight from Trader Chuck.
You have to think of the Beatles song Rocky Raccoon, but anyway, that was bizarre. I mean, it was literally 3 feet away from me. I'm that close to the sliding glass door.
Sounds like Florida. We're going to go over to Jordan. Thank you for all you do. Can we look at Lulu? I would like to short it after the earnings jump.
Wow, you're bold. Thank you for the comments. Lulu has been so strong. Let's take a look at the potential for a short. And I see what you're looking at, the gap up. And that's fair play because it gapped up, but it didn't cap all the way up to the recent highs. So it is kind of in no man's land. So I see what you're looking at here, and I'm kind of with you. This is one where I think your stop is easy here. If you want to go short, because it could easily just quickly fall back down and test 320. There's a ton of support there. I wouldn't short it below 320, but it is hanging in no man's land here. And to come down and fill that gap, I think you're onto something there. And then if it were to break above 380, that's your stop. You certainly get out of a short position. If it breaks above 380, it might even be a good long at that point in time. But just hanging where it is now, I see your idea on the short. We'll get some more retail sales data. We'll see, what happens the rest of the week. And as we move into more of the data from this quarter, see if it shows a consumer recession, and spending $120 for yoga pants, whether you're a male or female, seems like something that might be cut out of the budget if we go into a recession. So I'm kind of with you on the short there, but if it got back up above 380, I would be out of that short position.
Thanks, Rob. We're going to go over to LEN, the booming home builders sector.
Yeah, Lennar. I don't get this. I do not understand what's been occurring here with the building stocks. Why they've stayed as strong as they have is beyond me. So this is when you look at things, and if you're trying to look at it from a fundamental standpoint or from, okay, what's going on with interest rates on the long end, they're starting to tick back up. You just feel like perhaps we go into a recession. We've had a great run in the housing market. Seems like it would be a time for them to pull back. Not so much. A lot of stocks look like this. And the fact that we broke above 105 today on Lennar, I think is pretty impressive. Now, remember, one day to me doesn't mean anything. You have to have that second day or follow through day. But if we're looking at another higher close on Lennar tomorrow, I don't think that we stop here at this previous wave 5 at 110. That was one day. Just a vertical move up and quickly back down. I think this one could be in more for the long haul, but it has to close higher tomorrow. But if it were to close higher tomorrow, I think that's a good long. If it breaks back below it, I would be cautious and just wait and watch and see what happens. But I'm with you. Mind-boggling how strong and resilient the housing market has been, and that's where I come back to saying that you can't trade by what you think the market should be doing. And if you were doing that in the housing market, you've probably had a rough time.
Yes, indeed. All right, we're going to go over to a question from Jonathan. Is natural gas in C wave of wave 4?
Let's take a look. And, I've been waiting for this to catch a bid at some point. Thought we did it at 8. We had that move to the upside, but of course it was a vertical move, which I don't like. So there's your vertical move up and right back down. That's no good. That's not what we want. So we're trying again at 7. So we're consolidating here at 7. This looks pretty constructive. We're over extended, in my opinion, on the wave 5 at 122%. So we're well past the 100% extension level. I do believe we're oversold on natural gas, but I thought we were oversold at 8 as well. So take that into account. I've been wrong with the move down from 8 to 7, but it's trying again. So I think you could take another shot at natural gas here at holding at 7 and seeing if it can bounce back to the upside. If in some way, shape, or form, natural gas could get above 9, then you're off to the races. But you could still make a nice trade if it just bounced from 7 to 9. But look what would happen if it got above 9, then wow, you had this vertical move lower, there'd be nothing in the way. But unfortunately, when it tried to do it before, it did it in a vertical nature. That doesn't hold, and we came back down. So maybe we consolidate here and try again. But that's what it seems like. It looks like natural gas is trying once again to mount another run. But now we have 2 areas of resistance in the way. It's got to get back above 8 and then back above 9 to have any real traction. But perhaps you could make a short-term trade from 7 to 8 at least, and maybe 7 to 9.
Thanks, Rob. All right, we'll go with NEO here. That's an old favorite. I think one of the very first option trades I placed was from your strangle trade that you sent out way back when on NEO.
Yeah, interesting to ask that question today because it did catch a bid. I think I made this comment before that if you're looking for something longer term, the way China has become more protectionist and they've been giving Tesla some issues, and China's opening up from their lockdown, all those things seem to bode well for NEO, not from a short-term trade, but from longer term, even out in the leap type of area. I think this makes a lot of sense longer term. I think a year from now you could be very happy with purchasing NEO now. You can see right here we got this big vertical move and it turned around and came back down because it was a vertical move, but it consolidated, it held 9. We're trying to move back up. So now if we can get back above 10 without doing it in that vertical nature that doesn't hold, if we can just kind of mount a bit more of a 45-degree move here and get above 10, then I think we have some room to run in NEO. I mean, I really like the future for that stock, maybe not so much as a short-term trade, but in the longer term. So into low dollar stock. And if you got some capital that you're willing to just, hey, let me put it in something and come back and look at it a year from now, I think you come back and look at NEO a year from now and you'd be very happy with a purchase now. But for a short-term trade, I don't know. It isn't a qualified 5-wave to the downside pattern. And if it broke below 9 and started lower, you have to respect that. But if you're looking longer term, then perhaps you just add to it. But it's trying to bounce here. So I don't know if that wave 5 pattern to the downside is going to play out or become disqualified. I tend to give a nod towards that was a nice move to the upside today. That was pretty impressive. Let's get above 10 and then perhaps we have something there. So I see we're after 10 o'clock and the raccoons are out, but let's do one more.
All righty, sounds like a plan. We will go with Francois, who says, coin on uptrend or is a false rally?
That's a good question. That's a good one to finish on because with that big move that we had in Bitcoin and the crypto world, we had the negative news after coin tried to go to the upside on more regulations potentially come in that area. That's what made it gap back down. Isn't it interesting the way this works? You heard me say that I don't like vertical moves because they likely come vertically back down. So we get a vertical move here when it looks like we're going to take off, and then we get this news that the There are more regulations coming in this world, and they're going to look at Coinbase, et cetera. It gaps right back down, but, and that's an important but, it held 60. That was important. It held this area here, and it's basing and turning back. It's back above its 10-day moving average. So I think with Coinbase, we can be really interested in this. If you're super aggressive now, you could go ahead, I think, and go long because we have ticked back above the 30-day moving average. If you are a bit more conservative, let it break above 80. Let it break above 80 with a confirmation day, and you have plenty of room. Look at this from where it's been. Plenty of room to the upside. So you have the luxury, if you will, of being cautious here and letting it break above 80 with follow through and then getting in. But if you're super aggressive, you still haven't filled this gap right here yet, and you could perhaps enter now. Thanks everybody for your time tonight. You know how I feel about it. I'm really passionate about this. Time is the most valuable asset we all have. Very much appreciate when you devote some of your valuable time to us. Little added thing by one of the biggest raccoons I've ever seen being that close to me. Luckily, there was glass between us. But other than that, thanks for your time and attention. Have a great rest of your week.